TGIF. Hello, everybody. Welcome to the last Market Minds for the week. Happy Friday. The market's in a good mood today. Hopefully, it can hold this way through the end of the trading day. Can everybody hear and see me okay? Yes, Brad, how are you? Got my Cubby Blue on today. Big weekend series up with the Tigers this weekend. Hey there, Brian. How are you, man? All right, so what do we have in the market today? Very interesting how the market reacted to the jobs number this morning, because Wednesday, when we got that ADP number, which is not, as precise as non-farm payroll, okay? But when we got that number, which was much, much lighter than expected, the market looked at that as though, oh man, all right, the jobs market is now cracking. The economy is starting to crack. Rates came down considerably with the expectation that the Fed would potentially cut rates sooner rather than later. Today's number, a little bit better than expected. The expectation was for an addition of 125,000 jobs. That number came in at 135. Seems like it was the absolute Goldilocks number. If it had come in really, really light, okay, like the ADP number did, that would have been even more pressure for the Fed to lower rates sooner rather than later. Problem with that is, and everybody, wants to see lower rates, right? The problem with that is, if they lowered rates because things aren't good, because the economy's cracking, the job market's cracking, that's not a good reason. That is not a good reason. On the flip side, if we would have seen a number much higher than expected, 180, 200, 250, boy, that would have added fuel to the fire. Interest rates moving higher, Fed doesn't have to cut rates anytime soon. That probably would have hit the market. So this number that came in today, I think, is being analyzed as a number that shows that, all right, the jobs market is still hanging in there. Maybe it's not as hot as it was months ago, but it's still hanging in there, fighting off recession. And so that is, what the market seemed like it was reacting to. S&Ps are well off their highs of the day. They're still up 45 points. In fact, this was the first time since February that, there we go. This is the first time since February that the S&Ps got above 6,000, not all-time high, but you can see here, whoops, what happened to my S&Ps chart there? There we go. Okay, the high today, 6,016. Still a ways to go to those all-time highs, about 100 S&P points away. Nonetheless, as we have talked about numerous times, this move from here to where we are right now, I don't know, nothing short of really unbelievable. I mean, what a move that was. Oh, wow. Brian, thank you. By the way, guys, totally unsolicited here from Brian. Unbelievable. Appreciate that very much, buddy. Very, very nice of you. Very, very nice of you. I'm glad you're here. All right. That is that's how we like it. That is what we like to see and hear, because that is the reason we are here. All right. The V-shaped bounces are pretty aggressive, Leo. They really, really are. And, to what Leo was saying there, that is a V-shaped bounce. Now, I think there's a lot of concern out there that maybe this is going to turn into a W, which is something that we don't want to see, because that would mean we're coming back down here. Okay, but you know what? For right now, status quo is a good thing. Status quo is a good thing. That's unbelievable, Brian. That is truly a testament to your hard work, to, buying into what we teach, what we mentor here. So happy for you. I know how hard you worked at this, which is awesome. Absolutely just awesome. All right, guys. Today I do not have anything specific planned. Today is our rapid fire day. So I am hoping that many of you coming prepared, coming ready to discuss whatever you want to discuss, whether it's a stock, a position you have, whether it's a strategic question, economic question, whatever it might be. I am on the hot seat right now. I am ready. I am absolutely ready. So bring it on, everybody. I want to stay busy for the next 20 minutes or however long it is here. Bring it on. I'm ready for the weekend like everybody else, but let's get through all the good, dirty work first. Okay. Morning, Joel. You said you were considering a call vertical on Oklo. Okay. Because when we talk about a write-up like that in a particular stock, and that's going out to everybody, Clive, we want to keep it as simple as possible. Okay. If we had referred to in there, if we had referred in there a different type of strategy, people will look at that and say, oh man, I don't know what this is. I can't do that. But if you just talk about a call spread or a put spread or whatever it might be, okay, people will get the gist of that. Okay, any earnings plays on Oracle? So I do have Oracle up on my watch list here. Let's take a look at the charts. Here is Oracle, everybody. Earnings are on the 11th. Okay, so right now the stock is right in here. We have seen ever since earnings 2 quarters ago, so the December earnings, we have seen lower lows and lower highs. Okay, like many other stocks, especially software, tech stocks, what a V recovery, and here we are right now. So if I look at this, I'd be a little bit cautious, but there's nothing really to me that stands out and says I got to be bullish or bearish. So what I would look at is possibly an iron condor. Does everybody want to evaluate what that might look at to see if that is a viable or feasible type of strategy here? So let's take a look. Here's Oracle option chain for next week. We're trading 173.5. So everybody, what is the expected move in Oracle for next week? Okay, we got 15. What else? 14. Okay. I can go with either of those if we look right here. Okay, let's call it $14 to $15 expected move. So that puts us at, let's call it 159 up to 188. So if I'm evaluating an iron condor, especially for earnings, okay, what I want to look at are the two ranges, end of the ranges. And if I can set up an iron condor selling both a call spread and a put spread, that the break-even points are really, really close to what those expected range points are, I'm probably going to do it. So let's just take a look here, targeting 159. What if we did the 162.5, 157.5 put spread? And on the upside, if we did the 185, 190 call spread. Okay, if we put that out here, I can tell you for me, this is a non-starter. Why is it a non-starter? Probably the best I could do on this maybe is $2.20. Does everybody see that? So let's say we were able to sell this at $2.20. Okay. First off, let's calculate what our break evens would be. On the downside, it would be 160.30. So that's the short strike less the credit. On the upside, it would be 190.20. Excuse me. 187.20. Okay, so these are both close. They're not right at the expected range, the expected move, either end of the spectrum. That's not what concerns me so much. What concerns me is that, because if we sell this at $2.20, what is our reward to risk on this? Anybody? It is definitely less than 1-to-1. Definitely less than 1-to-1. And on an iron condor for earnings, we got to get right close to 1-to-1. So this would be 220 is what we could make. That would be our reward. Our risk, though, is 280. That puts us at 0.79 to 1. Definitely do not like that reward to risk ratio there. Definitely not doing this. Now, that doesn't mean there's not another setup, another trade to look at in Oracle. First thing I'm always going to look at when I look at a chart and I don't see anything that really guides me to a directional bias, I'm going to look at that iron condor. Am I afraid of getting to the closes on the short strike? What do you mean there, David? Oh, Julia, thank you for that. I'm going to take that personally if we don't get a lot of clicks on the like button now. Thank you for that. David, what do you mean? Too close? No, we'd love it to go to the short strikes. The short strikes are ideal. The short strikes are absolutely ideal. Okay, and remember the way that we trade, even in an iron condor here, is we always know what our potential worst case scenario would be. We always know what our maximum risk is to base it off of that. Okay, do I have concern? I've got concern about every trade I make. Okay, and where the stock may go. But again, that's why we're using the expected move with a 68% probability to give us that range. If the stock makes an outsized move, it takes an outsized move, or it makes an outsized move. You know, we can't factor that in. We can only play with the probabilities that are in front of us that are given to us. Okay, so we'll talk more about Oracle obviously early in the week on Monday, because it is in the news. It is a big earnings event for next week. How about an iron fly? It's going to be the same thing, Clive. It's really going to be the same thing. So we could look at, let's say, set this up here. clear this out of here. So give me the strikes you'd want to look at there, Clive. You tell me based on what the expected move was. No, it's not a matter of the bid-ask spread, Rocky, being too wide. In fact, the bid-ask spread was really tight. It's a matter of the credit that I could receive was just not enough. The volatility is not high enough. If I'm going to do a $5 wide iron condor, I got to get close to 1-to-1, close to 250 credit. This was 220 credit. Not going to do it. I just don't like the reward to risk on that. Okay, so once we figure that out, Clive, for the iron condor, the iron butterfly, it's going to be the same thing. Really is going to be the same thing. Okay, thanks for all the likes there, everybody. Other stock. Oh, what was one of my craziest stories? Oh boy. Randy asked, what was one of my craziest stories? Oh, man, I got a lot of them. I guess I probably default to when I was the only market maker in the world. Okay. And when I say in the world, I mean in the world trading Amazon options. So what happened was back in, I want to say it was either 96 or 97. I'd have to go back and look at the exact date. It was the summer of 96, summer of 97, when I am literally laying down on the trading floor in my current pit that I was in, trading Coca-Cola options, Bank of America options, Whirlpool, a few other stocks that were in there. It's like lunchtime. I am literally laying down in the pit doing a crossword puzzle. And over the loudspeaker, there was an announcement from the market officials saying, we need market makers to Amazon. So Amazon had just been listed. Okay, it just became a public company where options started to trade. It literally had just been listed. Now, back in those days, okay, back in the 90s, okay, every stock where options traded was on a different exchange. So it's not like right now where there are, when you go to send an order away, you can send it to multiple exchanges, right? 5, 6, 7, 8 different exchanges. Back in the day, if something was listed at the CBOE, at the options exchange, it was not listed on the NYSE. It was not listed on the exchange in San Francisco. It was not listed in Philadelphia. So there was single listings. So we, meaning the CBOE, randomly were assigned Amazon options. Now, we all know how volatile Amazon used to be. Okay, this was something new. This was something new to the trading world, seeing a stock, especially like a NASDAQ stock at the time, so volatile. Most people on the floor, most traders on the floor, we're talking hundreds, maybe even thousands of them, were used to trading old-time stodgy stocks like an IBM, like a Coca-Cola, GM. Okay, and when Amazon first got listed, the stock is all over the place. Okay, not only was the stock all over the place, but as many of you may know what a hard to borrow stock is, Amazon was hard to borrow, meaning that there was like no outstanding shares. The short float was huge. So that made option prices that much wackier because you had to price that in. So fast forward, long story short, I'm doing the crossword puzzle. The announcement comes out, need market makers to Amazon. I'm like, whatever. I continued on my crossword puzzle. 5 minutes later, there was another announcement. Nobody had gone over there. I'm like, fine. So I throw my paper down. I'm like, guys, and this was to the other people in the pit, I'm gonna walk over and see what's going on. So I walk over to the pit where Amazon was trading, which happened to be a pit that also traded at the time National Semiconductor, AIG Corp, and the traders in that pit wanted nothing to do with Amazon. So I walk in there, no computer, no what we called sheets or cards to give me any sort of theoretical values. And I just start trading. I just start making markets. And it was busy. It was swamped. And I'm just doing my thing. I'm just trading how I know how to trade. There was not another trader on the floor for the better part of 2 months. 2 months that wanted to partake in trading Amazon options. That was by far the best 2 months trading that I ever had in my career. So that one was kind of crazy. One more that I will talk to about. When the beginning of the financial crisis started in 07, 08, okay, I was trading for Goldman Sachs in the S&P 500 pit. And there was one day, I believe it was early September, it was either 07 or 08. There was one day, and it was the day after the market had really shown signs of stress, defaults were happening. It was the same day that Warren Buffett came in and backstopped Goldman Sachs. That was the day that the Fed came out with their first round of QE, okay, lowering rates to basically zero. So after the market had dropped, we're talking, S&Ps dropping 10, 15, 20% leading up to this. After the market closed on that day, the Fed came out with this QE announcement. Okay, and it was an expiration Friday. It was an expiration Friday. By the time we got back in to trade on Monday, S&Ps were up 20%. I had never, ever seen the whites of traders' eyes before, like I did on that Monday, with a lot of firms getting blown out because they were not positioned correctly, or not even just not being positioned correctly, but they were so short on that expiration Friday and it carried over. And then the Fed makes this announcement over the weekend. Nobody had anything they could do to adjust their positions. So that is, those are a couple. I mean, there's a lot more war stories, horror stories that I could tell you about, but those are a couple that really, really resonate. All right, let's take a look at a few more. Oh, Paul, there we go. What is acceptable? Hang on. I'm going to bring up something here for everybody. Hang with me here. What is acceptable, though, for that scenario on an iron condor? That would have been something close to 1-to-1. So you should all have a copy of this. If not, it's available online. It's available in the docs folder. Everybody should have a copy of this. And what we have done, thanks, Brian, what we have done is basically outline for you some guidelines. Okay, guidelines that I look for, guidelines that Mike looks for, depending on the option strategy that we are putting on, depending on whether it is based on earnings or not. This is a guideline to go with. David, I will happily look at Okta right after this. Okay, so if we don't get this type of reward to risk as a minimum on a particular strategy, we're not taking the trade. We're just not taking the trade. Now, it's easy for us to pass on it because we've been doing it for a really long time, and we understand that we don't have to take every trade opportunity that's out there, right? There's always going to be another trade. That I can promise you. Whether it's 5 minutes from now, an hour, tomorrow, 2 days, whatever it is, there will always be another trade to make that offers the reward to risk, the bang for the buck that we need. Okay. All right. Let's get this out here first, and then I'm going to look at Okta. TGIF. This is definitely a TGIF. Paul, there's always another bus. There we go, everybody. Let's get those TGIF. All my hobbies. Are you I haven't seen that name in here before. All my hobbies. Is this one of your first times in Market Minds? Thank you, Thomas. Big winner yesterday. All right, let's get to Okta while you guys are all getting your TGIF up there. Let's take a look at Okta. Okay. So what do you think? Okay, what do you think the absolute first thing my eyes just got drawn to looking at this chart? Something blaringly stands out. At least it does to me. Got it. Thank you. Awesome, awesome, awesome. Happy to have you here, all my hobbies. What stands out to you guys? Okay, there's big gap down. Certainly. That's one of them. What else? Once I'll give you a little push it, little prodding here. Once that gap down happened, what do you see? Below the 50-day moving average. Yep. Support at the 100. Let me put the 100-day in here because I don't have that, but I can put that in here. Hang on. Add chart. Hang on. What did I do here? No, I don't want that. What did I do? Oh, this is the vol chart. That's why. Okay. Hang on. I knew that I was kind of messed up here. Underlying. There we go. Add chart, moving average, 100. Okay. There we go. Great call. Who put that out there, by the way? Hang on. Who just put that out there about the 100? David Roberts did. Awesome job, David. Awesome job. Yeah. So, Steve, that's kind of what I'm looking at. And Clive, this consolidation right here coincides with this gap fill right here. And as David just pointed out, boy, we are just sitting right on top of the 100-day moving average. So yes, if anything, I would look to take a modestly bullish position here. So once we've decided that, let's take a look at implied volatility here. Implied vol is in the you-know-what. Look at how cheap implied vol is. So basically, what does that tell us? What kind of strategy, knowing where volatility is, what kind of strategy would be the first thing that we would look at? This is Okta, Thomas. Okay, what kind of strategy with bingo, RDB? You got it. Okay, we know the bullish part of it, but we can create a bullish strategy using 50 different ways. But what I'm thinking is because volatility is so incredibly cheap, we want to buy time, right? When vol is cheap, we want to buy that time. So a calendar or a diagonal, to me, would be the first thing I'm going to look at. Okay, so let's bring in an option chain here in Okta. Okay, and we already do have a diagonal on from a few weeks ago. But if we were going to look to put on something new, let's see, we're at 105 right now. Maybe we look at something like the June regular expiration 110 and the July expiration 110. That's a pretty inexpensive time spread, calendar spread. Gives you bullish bias. You're buying incredibly, incredibly cheap volatility. And because it's also 1 month, it gives you the opportunity to roll the June 20th options multiple times. Okay. So just at a quick glance, and we could certainly look at other setups as well, but just at a quick glance in Okta, that's what caught my eye from the chart. And that is what catches my eye looking at volatility of something that we might want to do. Does that help you guys out at all? Okay, great. Well, I can't believe we're already past 12:30 here. It's probably 5 o'clock somewhere, right? TGIF, it's got to be 5 o'clock somewhere. So, well, let's get to the wheel. I know I got it somewhere. There we go. Market Minds. There we go. Today's wheel. All right, let's see if we've got any of the current week winners on here. If you've won this week and your name comes up, we'll give you a clap. We'll give you a golf clap, but we'll spin again. All right, here we go, everybody. Ralph or Ray, it's close. Oh, Ralph, in the house. Ralph, are you in the house? Honorable mention. Ralph, are you here? Uh-oh, Ralph. We don't want to do this. It's only a good job, Kevin, if Ralph steps up to the plate and says that he's here. I hate to do the countdown. Ralph, you got 5, 4, 3, 2, 1. Oh, man, Ralph. Hate to do it to you, buddy. You gone. Let's spin again. Justin, Karen, Julia, who's it going to be? Julia's Journey, are you still in the house? 1 Alabama, 2 Mississippi. Yeah, it's like in a flag football game, right? 1 1,000, 2 1,000, 3 1,000. Julia, are you here? Bingo. We've got our winner. Julia, shoot me an email. We'll put the info up here momentarily. Shoot me an email with your swag size and also your mailing address, please. There it is right there. All right, everybody. Thanks for a great week. Really appreciate all of you. I hope you all have an amazing, amazing weekend, and we will get back at it on Monday. See you, everybody.